In 2008, the European Union and the United States stood as economic equals. Their gross domestic products, GDPs, roughly matched at around $16–18 trillion each in nominal terms. This parity reflected decades of post-war reconstruction, integration, and innovation that had positioned Europe as a global powerhouse. The EU, with its single market and currency, seemed poised to rival the US in prosperity and influence. Yet, by the dawn of 2026, a stark reality has emerged. America's economy has surged to over $30 trillion nominally, nearly doubling in size, while the EU's has grown modestly to approximately $20 trillion. According to the latest projections from the International Monetary Fund, IMF, and the European Commission as of late 2025, the U.S. real GDP growth is expected to hover between 1.9% and 2.8% in 2026, building on a robust 4.3% annualized growth in the third quarter of 2025. In contrast, the EU's real GDP is projected to grow at a tepid 1.4% in 2026, with the euro area dipping to 1.2% before a slight rebound. Nominal figures underscore this gap. U.S. nominal GDP for 2025 is estimated at around $29.5 trillion by Goldman Sachs Research, pushing toward $31 trillion in 2026, with inflation and growth factored in, while the EU's stands at $19.99 trillion in 2025 per World Bank data, inching to about $20.5 trillion in 2026. This is no fleeting anomaly. It's the Great Divergence, a relentless widening gap that has seen EU per capita income slip to about 70% of American levels. In 2025, U.S. GDP per capita reached approximately $86,000, while the EU average languished in the $50,000 to $60,000 range with stark disparities within the bloc, Luxembourg at over $130. Drawing from Mario Draghi's urgent 2024 report, The Future of European Competitiveness, which warned of a slow agony without radical reform, and the latest data as we enter 2026, this exploration dissects these interconnected scars. Draghi's comprehensive analysis, commissioned by the European Commission and released in September 2024, paints a dire picture. Europe faces an existential crisis, with growth rates half those of the US. Over the past 2 decades, a widening productivity gap and dependencies on foreign powers for energy technology and security. The report calls for $750 to $800 billion in annual investments, equivalent to 4 to 5% of EU GDP, to bridge these gaps through unification of markets, deregulation, and strategic industrial policies. It identifies root causes like regulatory fragmentation, insufficient R&D, and geopolitical naivety, urging a new industrial strategy to restore competitiveness. Yet, as 2026 begins, with geopolitical tensions escalating and economic forecasts modest, Europe's self-inflicted choices and external shocks have converged to threaten its place in the world. This divergence isn't just statistical, it's a narrative of missed opportunities, policy missteps, and structural inertia that demands urgent introspection. The fork in the road, post-2008, divergence and its roots. The divergence didn't happen overnight. It crystallized after the 2008 financial crisis, when paths forked dramatically. The global meltdown, triggered by the U.S. subprime mortgage collapse and Lehman Brothers bankruptcy, exposed vulnerabilities in both economies. In the U.S., the response was swift and aggressive. The Troubled Asset Relief Program, TARP, injected $700 billion into banks, followed by the American Recovery and Reinvestment Act of 2009, which allocated $831 billion for stimulus infrastructure and green initiatives. The Federal Reserve unleashed trillions in quantitative easing, QE, buying assets to lower interest rates and spur lending. This ignited a tech-fueled boom, with Silicon Valley's innovations in cloud computing, AI, and e-commerce driving productivity gains. By 2010, U.S. unemployment peaked at 10% but recovered rapidly, falling below 4% by 2019. GDP growth averaged 2.3% annually from 2009 to 2019, propelled by shale gas revolution reducing energy costs and fostering industrial resurgence. Europe's trajectory was markedly different. The crisis morphed into the Eurozone sovereign debt crisis, gripping Greece, Italy, Spain, Portugal, and Ireland. Bailouts from the Troika, European Commission, ECB, IMF, totaled over $500 billion but came with stringent austerity measures, fiscal consolidation, pension cuts, and labor reforms that choked recovery. Greece's GDP shrank 25% from 2008 to 2013. Spain's youth unemployment soared to 50%. The European Central Bank, or ECB, delayed QE until 2015, and national fiscal rules under the Stability and Growth Pact limited stimulus. GDP growth averaged below 2% annually for over a decade. with productivity stagnating at 0.5 to 1% per year versus the US as 1.5 to 2%. By 2024, American GDP had ballooned to around $28 trillion nominally, with projections from the Federal Reserve as December 2025 Summary of Economic Projections pushing real growth to 2% in 2026 and nominal toward $30 trillion. Europe's response, constrained by monetary union asymmetries and a political fragmentation, left scars. Southern Europe's lost decade of high debt, Italy at 140% GDP in 2025, and low investment. As of late 2025, EU GDP stands at roughly $20 trillion nominal per Eurostat and IMF data, with per capita figures lagging far behind the US at $86,000 versus Europe's $50,000-$60,000 average. Eastern Europe has converged impressively. Poland's GDP grew 4% and 5% annually post-crisis, reaching $1.1 trillion in 2025, and Romania posting strong gains through EU funds and manufacturing relocation. Geopolitical shocks amplified vulnerabilities. The COVID-19 pandemic in 2020 to 2021 saw the U.S. deploy $5 trillion in relief via CARES and ARP acts, accelerating digital transformation. Europe's $750 billion Next Generation EU fund was groundbreaking but dispersed slowly, with only 40% utilized by 2025 due to bureaucratic hurdles. Russia's 2022 invasion of Ukraine disrupted energy supplies, spiking inflation to 10% in the EU versus 9% in the US. But Europe's dependency on Russian gas, 40% pre-war, led to a deeper recession. Energy prices soared, industrial output fell 5% and towered 10% in energy-intensive sectors, and inflation averaged 6% in 2023-2024. The U.S., self-sufficient in energy via fracking, weathered this better. Structural flaws run deeper. Europe's aging infrastructure, fragmented markets, 27 national regulators versus U.S. federal cohesion, and precautionary regulatory approach hinder agility. Draghi's report quantifies this. EU productivity growth is half the U.S. since 2000, with a $700 billion annual investment gap in tech and infrastructure. Without reform, Europe risks slow agony, as Draghi warns, becoming a vassal to U.S. innovation and Chinese manufacturing. Wound 1. Deindustrialization, the erosion of Europe's manufacturing core. The first fatal wound is the deindustrialization of Germany, Europe's industrial powerhouse, which accounts for nearly a quarter of EU manufacturing output. Once synonymous with precision engineering, Mittelstand firms, and export dominance, Germany exported $1.5 trillion in goods in 2021. Led by autos, chemicals, and machinery, the sector has contracted sharply since 2022. Manufacturing's share of German GDP fell from 23% in 2010 to 18% in 2025, per Federal Statistical Office data, with output declining 5% year-on-year in 2024. The culprit? Skyrocketing energy costs following the abrupt cutoff of cheap Russian gas after the Ukraine invasion. Pre-2022, Germany imported 55% of its gas from Russia at low prices. Post-sanctions, reliance shifted to expensive LNG from the US and Qatar. Industrial electricity prices in Germany remain 3 or 4 times higher than in the US or China, around $0.38 per kilowatts in late 2025 versus $0.08 in the US, according to Reuters and Deutsche Bank reports. This has rendered energy-intensive industries uncompetitive. BASF, the world's largest chemical producer, has permanently downsized its Ludwigshafen site, closing ammonia and fertilizer plants and shifting $4 billion in investments to China and the US, where shale gas ensures affordability. Over 2,500 jobs were cut in Germany alone by 2025, while BASF expanded in Texas with a new $1 billion facility. Steel giants like ThyssenKrupp idled blast furnaces in Duisburg, laying off 3,000 workers, and ArcelorMittal reduced output by 20% across Europe. Automotive suppliers, from Bosch to Continental, face existential threats. Volkswagen announced 30,000 job cuts in 2025 amid EV transition delays and Chinese competition. Germany's Manufacturing Purchasing Managers Index, PMI, has hovered in contraction territory. This deindustrialization ripples across Europe. Chemicals, metals, and autos, sectors employing 30 million EU-wide, bleed jobs and investment, eroding the middle-class foundation of prosperity. In Italy, steel production fell 15% in 2024. France's chemical output dropped 8%. Eastern Europe's gains, Poland's manufacturing up 10% via nearshoring, can't offset core losses. Draghi's report highlights this as a loss of industrial sovereignty, estimating 20% of EU industrial value at risk from high energy and regulation. Recommendations include an EU-wide energy union, grid investments, $500 billion by 2030, and subsidies for green hydrogen. Yet Germany's coalition government dithers. A proposed industrial electricity price cap at 0.05 kWh from 2026 aims to stem outflows, but critics argue it's too late. Without reversing this, Europe risks a vicious cycle. Lost jobs fuel populism, reduced exports widen trade deficits, EU deficit $100 billion in 2025 energy imports, and weakened fiscal bases limit green investments. Historical parallels abound. The UK's deindustrialization in the 1970s, 80s, when manufacturing shrank from 25% to 10% of GDP amid high energy and unions, offer cautionary tales. Germany's case is self-inflicted, ignoring warnings about Russian dependency, as noted in a 2018 Bundesnetzagentur report. External factors like U.S. Inflation Reduction Act, IRA, subsidies lured $50 billion in EU investments stateside in 2023-2025. Case studies illustrate Lanxess spun off units to U.S. buyers. Siemens Energy reported $2 billion losses in 2024 from wind turbine failures. Interconnections with other wounds are clear. Demographic shortages exacerbate labor gaps in factories. Innovation lags mean missed EV opportunities. Capital flight funds, U.S. rivals. Projections for 2026. If energy prices stabilize via Nord Stream alternatives and LNG terminals, growth could rebound to 1.5%, but persistent high costs threaten further contraction, per IFO Institute forecasts. Wound 2. The demographic death spiral, a shrinking and aging continent. Compounding, the pain is the second wound, Europe's demographic death spiral. Birth rates have cratered to historic lows, far below the 2.1 replacement level needed for population stability without immigration. This isn't temporary. Trends span decades, driven by multifaceted factors. High living costs, housing prices in Paris and Berlin up 50% since 2010, delay parenthood, with average maternal age rising to 31 years EU-wide. Career pressures, especially for women, clash with inadequate support. Only 30% of EU children under 3 have formal childcare per OECD. Shifting social norms, later marriages, cohabitation, individualism, reduce family sizes. Economic uncertainty post-2008 and COVID exacerbated this. Births fell 4% in 2021, a baby bust. An aging population means fewer workers supporting more retirees. By 2040, the old age dependency ratio, 65 plus to 1564, could exceed 50%, up from 32% in 2025, straining pension systems. Pay-as-you-go models face collapse. Italy allocates 16% of GDP to pensions in 2025. Greece, 15%, versus US's 7% with private funds. Taxes rise to plug gaps, with effective rates reaching 45% in France, discouraging families further and prompting immigration. Brain drain accelerates. Over 5 million young professionals from Southern and Eastern Europe migrated to the US, UK, or Germany since 2008, per Eurofound. Portugal lost 10% of its youth. Romania's workforce shrank 15%. Without robust immigration, often politically contentious with integration issues like language barriers and cultural clashes, workforces shrink annually. Italy's working age population declined 1% yearly since 2015. Bulgaria's by 2%. Consumer demand weakens as retirees save more. Innovation pools dry up with fewer young minds. Fiscal pressures mount, with debt servicing crowding out investments. Draghi's report starkly warns, this spiral risks slow agony, demanding policies to boost births, universal childcare, tax credits, and attract 1 to 2 million skilled migrants annually. Yet resistance in aging societies, populist parties in Hungary and Italy restrict immigration, slows action, locking Europe into decline. Comparisons highlight severity. U.S. fertility at 1.62 in 2025 benefits from immigration, 1 million legal annually, and family-friendly policies in states like California. China's one-child legacy yields 1.1, but aggressive incentives reversed trends slightly. Europe's history, post-Woodwig baby booms peaking at 2.5 in 1960s, shows reversibility, but current inertia persists. Wound 3, the innovation vacuum, trailing in the digital revolution. The third wound strikes at Europe's future, an innovation vacuum that has left it trailing in the digital age. While the U.S. spawned Apple, $3 trillion market cap, Google, NVIDIA, AI leader, and OpenAI, driving trillions in value and 50% of global unicorns, Europe boasts no top 10 global tech firm by market cap in 2025. ASML, Netherlands, ranks 15th at $400 billion for chip tools, but relies on U.S. markets. Spotify, Sweden, is niche. Venture capital, VC, inflows are a fraction. EU attracted $50 billion in 2024 versus US $200 billion per pitch book. Startups face fragmented markets. 27 regulatory regimes versus US uniformity, and compliance burdens costing $100 billion annually. The GDPR 2018 and Digital Markets Act, DMA 2022, exemplified regulation before innovation, noble for privacy and competition, but they've imposed billions in costs, delaying AI rollouts. Meta paused EU AI training in 2024 due to GDPR scrutiny. Apple delayed features citing DMA uncertainties in 2025. Fines totaled $6.7 billion on US firms in 2024, per ITIF. Promising firms get acquired, DeepMind, UK by Google, or outcompeted. Europe's unicorn share hovers below 10% versus US 50% and China's 20%. R&D spending lags at 2.3% of GDP in 2025 versus US 3.5% and China's 2.6%, per Eurostat. Brain drain persists. 30% of EU STEM PhDs work in US, fueling breakthroughs like mRNA vaccines. As 2026 dawns, AI and semiconductors dominate. Europe imports 80% of chips from Taiwan. US exports jobs. Draghi urges deregulation, unified digital market, $100 billion Horizon Europe boost. But bureaucratic inertia and precautionary principle hinder risk-taking. US has 6x more startups valued $2.2 trillion higher per Reddit analyses. Interconnections, demographics, drained talent, capital flight funds, US VC projections. Without change, EU tech gap widens 20% by 2030. Wound 4, capital flight, savings fleeing abroad. This innovation lag feeds the fourth wound, capital flight. European savings rates are high at 15% of disposable income, yet trillions flow abroad. Households prefer bonds, companies list on NYSE. $50 billion FDI outflows in 2023, per Draghi. Low returns, stagnant growth drive this. Draghi calls for capital markets union. US markets hit records, EU lags. Wound 5, energy suicide, ideological over pragmatism. The fifth wound is energy suicide. Nuclear phase-outs backfired, prices 3-4x US renewables at 40%, but intermittency issues. China dominates supply chains, investments 494 by in 2025, but affordability lags. Wound 6, ending geopolitical freeloading, defense awakening. Finally, low defense, 1.5 to 2% GDP, ends with Russia's threat, spending to 381 B in 2025 with NATO's 2% target met by 23 allies, but calls for more strained budgets. Paths forward, renaissance or decline. Draghi's blueprint, massive investment unification. As 2026 begins, Europe's choice looms.